Homeloans TV, our bi-monthly presentation, and again today got Jess Vaiano. Jess is one of the BDMs with the Advantage Essentials product with Connective Home Loans. Welcome, Jess.
Thank you, MG. Good to be here.
Yeah, I did when in the blurb that we put out for today's session, we did put in there a couple different categories or topics that we will discuss today around, and I think a few of them are very topical at the moment. We've seen some changes in policy with some lenders in relation to things like high density apartments. We'll also have a bit of a talk about genuine 100% offset, when it needs to be an offset, and when you can get around with other alternatives as well. The normal programming is that we have our special competition, fastest finger first. So make sure that you've got your mobile handy next to you. We'll flash up a number a bit later, and for the first person to call in, you get to win a prize.
Excellent.
So a bit of fun with it as well. So Jess, we'll kick off. I suppose the one of the topical things at the moment is the investment lending and some of the changes to the policy.
Absolutely.
If you just want to give us a bit of an update where Advantage are at as far as policy and investment lending is concerned.
Yeah, I think from an investment lending side of things, we've kept our policy steady for quite a while now. And where we really see a lot of investment lending coming into us is particularly around serviceability. So I think what we've seen out in the marketplace is a lot of lenders, and it's spanned out over the last 6 to 12 months with changing calculators. What we found is that for clients who have a lot of investment lending, and particularly where it will remain as OFI debt, our calculator tends to be one of the strongest available out there. And that's due to the way we treat the OFI, and we still use the full tax deductible interest. And our rental income hasn't changed from the 80% mark as well.
So rather than using a floor rate or a servicing rate on the remaining debt, you've got you set repayments, whether it's interest only or P&I, and there's a loading onto that? Yeah,
correct. So what we will do is we'll load it by 30%. So 30% does sound a lot, but when you actually look at it in true terms, it's not really. So if you've got a client who's got an investment loan that's interest only, which majority tend to be, we actually don't convert that to principal and interest. So what we'll do is we'll then load the true interest only repayment by 30%. So if you say on average, maybe your investment rate is about 4.5%, if you load that by 30%, it takes you to about a 5.86.
Yeah. Well, it's actually, even at 5% at 30%, it's a whole lot cheaper than what, say, 7.4 or whatever that you'd usually service that out at.
Yeah, exactly right. And once you think, if a client has 2 or 3 investment loans, quite quickly the gap between the repayment we use and what some of our competitors will use becomes quite large, and it really gives you a great improvement on your serviceability.
Yeah. Okay. I suppose the other thing that we've found, and even getting to PD days, just with some of the different lenders, with some of the special offers that have been on recently, I think there's variable levels of turnaround times and servicing.
Yeah.
I think some of the lenders are out to 10 working days or whatever. But I know that they're also talking about quality of applications.
Absolutely.
Now as well. Where are we sitting at for turnarounds at the moment for Advantage? I suppose it's not just Connective Home Loans, it's really, it could be the other aggregators as well. So
yeah, I think from the Advantage side of things, the thing that's really promising for us is, our volumes have increased quite a lot with the rates we have at the moment being extremely competitive, and we've really maintained our service levels on turnaround times. So at the moment, on an average deal, you can expect a turnaround time of 48 to 72 hours. Yeah. And where a lot of those ones that tend to go to that 48 to 72 hours mark is particularly on your complex deals. Mainly because some of those deals, it's not your standard 45 minutes to assess. It can take a number of hours. Yep. But what we're really doing within our business is we're also prioritising those deals that have fully packaged applications. So, deals are coming with a valuation up front, your income documents, your signed broker declarations on the application form. We're actually prioritising quality. So it really ties into the real quality of the application. Yep. And those deals there, we're still turning around those deals within 24 hours.
Yeah. I know with the ASIC inquiry into the broker commission side of things, they are looking very closely at the soft register as far as beneficial programs for volume. And I think, you've got some of the lenders out there at the moment, not necessarily meeting their turnaround times. And I think you'll find all of the lenders over the next 6 to 12 months concentrate back more on the quality side of applications, and trying to influence the quality that you guys actually put together and be rewarded for quality rather than for volume. And I think that's going to be the real focus moving forward.
Yeah, and I think that, I had a perfect example actually of that this week. So I had a broker who'd submitted their first deal. It was a fully packaged deal. They actually had a response in 3 hours from when they lodged it.
Yeah.
Now, you're talking quality is what drove that turnaround time, not volume. So we'll have brokers who'll give us a lot more than that. That was his first deal, but got the right turnaround time due to the quality.
Yeah, I think, and then if there's no anomalies, everyone's getting the same level of service, and you'll get the level of service based on the quality of your submission and application. The other exciting thing about that, I suppose, is that whilst you concentrate on quality, I know most lenders basically want to be a one-touch approval. So as much that can go into that application pre-submission, and I'm talking about things like upfront valuations.
Absolutely.
Or even as some lenders have as a curbside or basically a desktop valuation. Even some lenders have got, like our Smart Options has got the Veda reports up front. So really getting a fully packaged file so that the underwriter is only spending a minimal amount of time to assess that deal and come back with an approval.
Yeah, that's exactly right. If you provide everything up front, there's no reason a deal shouldn't be formally approved. And I think, a lot of brokers tend to ask me, well, when you talk to quality, what happens if something's outside the square? We're aware, and I'm sure every broker experiences it out there, that most deals aren't vanilla. Yeah. Things will have a little twist or a little quirk, and I think from our business, that's where the benefit of our scenarios team really comes to the front. Because if something is outside the square, you can actually have scenarios, review it, sign off on an exception, so once the deal comes in, that exception's been approved. Yeah. Or it may be something where, an exception around income or employment, where we may need a little bit more verification. And if that's the case, when you submit that credit package, to actually provide that up front. So it really speeds up the turnaround time and helps you get that formal approval at the first touch.
The one thing that I've been really happy with since we relaunched Connective Home Loans last year is the relationships that have been built from the brokers. There's some great relationships with the BDMs on the road, but there's also some really great relationships that I've seen between the brokers and those scenario teams and the underwriters as well. And a better relationship that I've seen with a lot of other lenders. Yeah. So the guys are approachable. I think that, brokers are realising that these guys are actually the decision makers. And if they say something's a deal and it comes in exactly the same way it's chatted about, it's the deal. So there's not that full reliance on having to talk to the BDM all of the time. There's multiple people that you can talk the scenario or the deal with.
Yeah, absolutely. And I think that really ties into our service proposition as well. We have state-based teams that are dedicated to each broker. Yeah. So it's not that your deal will go into a conveyor belt, so to speak, and potentially be picked up by 50 or 60 people. Each of our state-based teams will have 8 to 10 people in them. So they actually really get to build those relationships and get to know each other and how each other works. And I think that really ties into the fact that you also have direct access into the credit team with their phone numbers and their email addresses. Yep. So you're really working and building those relationships rather than dealing necessarily with call centres or really large teams where you don't really get to build that personal touch.
Yeah. One part of it, exciting news, but we know it's coming. We just don't have the launch date yet. But Advantage is going down the road of AVMs.
Absolutely.
Yeah, so that's pretty exciting. So that'd be great for those refinance deals to get those desktop vals in. Exactly what your valuation is and what the LVR is going to be. So it takes a lot of the guesswork out of whether it's going to be a deal or not.
Yeah, that's exactly right. So it should be coming hopefully in the next 6 to 8 weeks if all goes to plan. So it's going to introduce your AVMs, your curbside and your desktops as well. So really speed up that process and help the turnaround times even further from when a broker starts dealing with a client to the end process. Yep. So it's really going to be a great win to expand our our promotion and our opportunities further. But the other thing I think that's, I found really positive with it is, some brokers who you mentioned it to get a bit hesitant because they're worried about what the valuations will come in at on an AVM.
Yeah.
So we actually will have the ability where if it's an AVM or if it's a curbside and we don't feel it's the right valuation, we can actually escalate that and get, the next level of valuation, a full valuation completed. So you're not necessarily stuck to the AVMs. You've almost got a best of both worlds approach.
Yeah. Okay. Just a reminder too that if you've got, anything, any of the topics that we're talking about, if you've got any questions or even if you want to make a comment, type them in. We've got the screen up here so we can, deal with them straight away. And obviously, if there's a relevant question that you've got out there, quite often a whole lot of other brokers have that same question as well. So don't hesitate to type those questions in. We can see them on the monitor and we'll answer them. Just the next thing that I want to talk about, Jess, is we've noticed in a couple lenders in the last few weeks have actually restricted their policy and LVRs in and around high density apartments and real estate. What's your thoughts around that?
I think it's an interesting time in the market because we're starting to see a lot of feedback, and I'm seeing this from a number of brokers and not through valuations with us, right across the market, that your off the plan purchases and your unit developments, there's some issues with the valuations now.
Yep.
And I think that's what's prompted some hesitation by some of these lenders. I think the real key part with the Advantage business is we haven't changed our policy, we haven't moved our policy. And nor has QBE from a mortgage insurance perspective. So there are some restrictions around high density within the insurance space, but within our business we haven't changed that. But it's an interesting time in the market, I think, and particularly with the restrictions now coming around, the Asian investment as well. It's a unique time.
Yeah, I think, the one thing that you really got to think about is the fact that there's been that shift from the foreign investor. And there is so many contracts in place out there of purchases off the plan that have not yet settled, that the potential is that due to the changing policy that they might not find funding for that. Yeah. So then again, if the settlements, if the actual settlements for those fall over, you could see basically the stock in an entire building, just because 2 or 3 settlements fall over, the value of the stock goes down. So I think there's that bit of a cautious as we go, but that's definitely what's coming out at the moment. We're getting a couple questions up on the screen there. We've got one there from Brett Maple. What's time and money to investor will see common sense applying to overkill? Look, I think it's just a matter of the market just sort of settling out. You actually see some of the lenders at the moment reducing their rates around the investor. They've got the balance of their portfolio right after the correction, and are now starting to go out and be a little bit more adventurous as far as rates are concerned, and buying a bit deeper with the investment properties as well.
Yeah, and I think you're right. Now, a lot of the lenders have got their cap where it needs to be. I know on the Advantage side, because we form part of NAB, we've got our cap where we need to be, and we've started to loosen up those policies as well. Yeah. I think the important part of what I'm seeing come out of our business and product is we're trying to do it in the right way. Yeah. We don't want to do a grab for business 1 month and then change policy the next. We really want it to be a consistent approach.
Geez, you're coming through thick and fast now. We've hit a topic.
Excellent.
Okay. There was one that went back, and it's actually just gone off the screen at the moment. Wanted to talk more around the need for quality as far as applications are concerned. I think it was actually seen the CBA, and I think it's pretty consistent, is that the first thing when any of the executive are coming out or at the moment, the first thing they'll do is apologise for the delays in the turnarounds. But ultimately they're pointing back to saying, we're still getting to 10 days or whatever, but we're concentrating more on the quality side of things as well. Yeah. What other things do you see in the quality side that lenders would be looking for, Jess?
So what I tend to see, and what we see in our business, is it's a lot of the little things that get missed. So from what we see in our business, it's about 30% of our applications that don't come in with the broker declarations on the application form completed, the signed privacy and the signed ID form. Now, every broker I speak to when I say that number goes to me, oh really, everyone should be doing that, everyone should be getting that right. But a lot of people, miss that. It may be a slip up or a simple mistake, but it's more, concentrating on the basics, I think, that's really important. Most deals are when it comes to a documentary evidence and what we require as a lender, it's pretty straightforward. If you've got an applicant that's PAYG, it's one payslip if it's got a year to date. Pretty easy documentation to provide. So it's not actually so much those deals that are unique and outside the square where there is a bit of working together with credit to get it over the line. It's actually a lot of the basic things that if brokers get right will actually help improve the quality. Perfect example is those valuations we talked about. We get a large number of deals without a valuation. Now, if you take pre-approvals away from that, why wouldn't you order an upfront valuation?
Yeah. I think, the other thing that you've got to bear in mind is that third party now does account, and it's creeping up all of the time, is up to 60% of, loans that are going through a bank. So obviously if 60% of their business is coming through this channel, they've really got to make sure that, to better that, they've got to make sure that they've got those turnaround times, that you've got consistency across the board. I think the real benefit for broker is that there'll be more competition in that faster turnaround in the grab for the quality business. And I think, you'll get your incentives, not necessarily for broker, but incentives maybe for end customer rate, for quality submissions in relation to deals going forward, which is, it's great for the industry, great for broker.
Yeah, exactly right. And the way I'm looking at it is it's almost a help us to help you approach, because the more deals that we can turn around as a first touch formal approval, then the next deal's going to get assessed quicker and the next deal after that. So, by brokers submitting fully packaged deals, you'll have a formal approval as your first touch, which is the best experience any broker and client can have. No broker wants to rework a deal, and from our business, we don't either. So it's actually in everyone's best interest to really try and get that quality right. And as I said, it's the simple things, just to make sure that those documents needed are there. It's not a complicated checklist, generally with most lenders, not just with us, to follow for the basics.
We get on to one of the other topics we talked about was offset. And I actually just see a question just come up on the board there in relation to mentioning another white label product that allows them to link an external bank account for an offset account. So I think if the external bank account, unless that was the balance sheet that was funding the loan in the first place, that'd be pretty hard to link back to the loan. But look, the one thing that we get, and when we set up Connective Home Loans, we were very mindful that we wanted a lot of brokers request that 100% offset. A lot of customers think in their mind that they want that 100% offset. So we definitely have that option with the smart options. But I think we're finding there's a bit of an education process going through, especially with the Advantage product, that we've got a lot of brokers and customers now a lot more comfortable with that fully transactional home loan. And basically at the end of the day, I suppose the 100% offset is, yes, you have a separate account where you get a separate statement and it offsets against that balance. But the main thing to have that sitting separately is obviously if you've got an investor that wants to put money in, and I don't know why a lot of them want to put money in because they're geared to the hilt anyway for taxation reasons.
Exactly right.
If they want to put that money in and park some money in to take it out at a later date, if in simple terms, if you do that, put money into a loan and draw a debt back up in an all one transactional loan, you could fall foul of the ATO because you're not allowed to draw the debt back up. So that's the main thing, I suppose. That you need 100% offset if that's the intention. You have an investor, they are going to park some funds and then draw that debt back up or down and up again. But other than that, it's really getting a customer comfortable if they're not in that situation with a fully transactional loan account. Jess, you've talked to a lot of brokers that have that conversation with their customers. Just give us a sort of a best practice as far as that's concerned.
Yeah, so the way I kind of look at it is, and the one question I'll always ask brokers, predominantly is, do you sell with an offset and why? And the feedback I get for most of the clients is, it's for the interest savings that you can achieve.
Yep.
There are going to be those true investors who will need an offset, but for the most part, it's a client wants to save on interest. So the example that I always give, and it tends to be a really easy one for the clients to also wrap their head around, is pretend you've got a loan of $500,000 and $100,000 in savings. In a traditional offset scenario, you would have your loan limit at 500, your loan balance at 500, and then 100,000 in a separate offset. Now you can have a debit card linked to that offset, salary credits, but your interest is charged on 400 because your 100,000 will offset your loan balance. With a fully functioning redraw, you get the same benefit of the interest saving. It's just that it's structured out of one loan account. So the scenario with a fully functioning redraw is you'd have a loan limit of 500,000.
Yep.
You'd have 100,000 sitting in your redraw. And same thing, you can have a debit card, salary credits into there as well. Your loan balance would be at 400,000 and your interest is charged at 400,000. So in either scenario, you're actually having interest in that example charged at 400,000.
Yep.
Now, whether it's a offset or a redraw. And the benefit with the Connective Home Loans product is this beautiful debit card we have here that you can see is actually branded Connective Home Loans. So it's something that as a broker, that when you're selling this product to your client, they're actually getting a debit card that links them to the client. And when we talk to referrals and white label funding, I think that's a really key point. I think you give a really good example on how that works.
Yeah. I think the fact is that the customer associates obviously with Connective Home Loans. It's not Westpac or NAB or whatever, so it does drive referrals. But the one thing, and you've got your Connective Home Loan through Essentials. I also have one through Essentials. The one really good thing that I like about it is that I do have another 2 interest-only splits on mine. They sit at a zero balance, so I've just kept them for a rainy day. But when I took out the loan, I was not going to take up to the 80% LVR. So I actually have 2 splits sitting on zero, interest only, that don't close because they're on zero, and I can draw them down at any time. And I can also get them in a situation, because I have my salary paid in, that it doesn't look for any interest-only repayments at any stage. So I've really got these 2 little line of credits sitting off the side of my loan through 2 different splits. And yeah, happy days. It's a really good one. So I think you find with a lot of other lenders, if it goes to a zero balance, it closes off, you lose access to it, and that's it. So I reckon that's a ripper, and I think that's an important thing to know, that you can do that. Borrow up to the 80% if the serviceability does it. Have that little bit sitting off on the side, that an interest-only split. Don't draw it down, but it'll save your customer coming back for that increase later on if they are going to do an investment property or something like that. Yeah,
and I think to that investment property, that's where we actually see a lot of people use that facility, is where traditionally, and I'm sure a lot of brokers will see cash out on an own OC to go purchase your next investment, and by having that separate split sit at a zero balance, it's no cost for the client, but when they find that investment property, they can withdraw the funds. The purpose is clearly allocated, so from a tax benefit, it's perfectly set aside, and they've got those funds ready to be used. And I think that's also important with the cash out, is that when the clients move the larger lump sums, our redraw is free and unlimited. So it's also unlimited on the dollar size, which means you can move your $100,000 to go make a deposit on that new investment property.
Yep. Actually, I've just got a question up there, George. He's put, hey guys, can we talk further about quality and pricing? When does it get applied? After a deal is assessed or confirm its quality? I think the one point there, George, is that it's an education process, so you can't, and we do, obviously you can talk to your local BDM about the quality program, but we are prepared to give discounts on the end rate to the customer And it's not a, boom, boom, you know, you didn't put the quality in, so you don't get the discount. We realise that it is an education process over a period of time. So I think you'll find, like us with a lot of other lenders, saying, this is what we view as quality, and these are the points that we want done in a quality submission. This is what we need you to work towards, and you'll have quality programs that don't have a defined end date. If you continue to give that quality, you would continue to get a discounted rate. That's the way we're looking at it, and I think that's the way you'll find some of the other lenders will look at it. You might get some preferential concession pricing for the customer if you continually provide quality submissions and applications to that particular lender. So we can only talk from, I suppose, the advantage and connective side, but I would say you will see that duplicated with a whole lot of other lenders going forward in the quality piece. Yeah,
and I think the one thing that the way I'm tending to look at it is, you know, we're really trying to, you know, change behaviour across, you know, brokers and not just connective, you know, all of our different aggregators. You know, it's a change in behaviour, and I think it's in a broker's best interest to now really focus on that quality, because when you look at those quality specials, you know, if, you know, the lenders and, you know, us particular as well, see a change in behaviour and see an improvement in quality, then we're going to be more encouraged to keep these sort of programs going and to really evolve those sort of programs. Yet, if brokers essentially don't do the right thing then, and there's no change in behaviours, then you'll start to see some people, like you said, moving away from it. So it's really in everyone's best interest. It's, you know, brokers helping lenders to help clients and help brokers. Why wouldn't you focus on quality?
That's it. I suppose just to maybe before we do go on, maybe we have our fastest finger first. So let's see if I'm going to pop this phone number up here. If you want to give that a call, and we'll get the first person through. And I think we've got a $200 Myer voucher today. So
excellent, not a bad prize.
0418 99 3362, and here we go. We've got one coming in now. Michael Gurner speaking. Who have we got there? Hello?
There's a lot of static currently.
Hey, who have we got? Oh, someone in a submarine. Hey, I've got... Sorry, who is it? Oh, how are you? Very good. I've got your mobile number on here, so I will give you a call a bit later on, and we'll get that prize to you. Well done.
Terrific. Thank you, Michael.
Congratulations. Okay, bye.
Bye.
All right, so that's our fastest finger first.
Excellent.
A funny line there. I think we're getting a bit of feedback. I don't know. It sounded like it was a deep sonar in a submarine or something. Just what's happened in the market since the last RBA rate movement. You know, we talked about, we were probably a little bit out of the market. I think at that stage we were 4.14 on a standard variable rate. We had other players in the market. I think there was the Suncorps in there with their 399s. Yeah. There was ING, there was AMP. The great thing that happened for us, we moved, because we're pretty much sitting middle of the road. Yeah. We moved our 25 basis points on the new business rates, where some of the others that were in the front of the market decided not to, you know, they'd been obviously getting business in and not reduce their new business rates. So we're sitting pretty good at the moment at a 391 standard variable rate and pretty much front of the market. And we've seen that through volumes in the last 5 or 6 weeks, where we're running at about 200% on volumes as what we were in the previous months. I think the one thing that it's probably worthwhile having a chat about now is there's a lot of talk post-election, lenders then going back and, you know, taking a bit of that margin back in relation to new rates, and maybe even if the rates don't go up or down, lenders making a move or a margin grab out of sync with the Reserve Bank. Yeah. What are your thoughts on that?
Yeah, I think there always tends to be a lot of talk around that whenever there's an election on, and you it's an interesting time in the market because there's a fair bit of uncertainty. And a lot of people I'm speaking to are thinking, well, what happens if, a Labor government gets in? Because there was a lot of talk. It seems to have dried up a little bit now, but on the negative gearing side of things as well, and the impact that could have on the market. So I think it's an interesting one. We saw, a number of lenders do it last year when they moved out of sync with RBA. So we know, I wouldn't say it's the norm, it's something that may happen, but I think now, while the rates are as low as they are, fixed rates is a really strong opportunity for clients to be looking at, because you've got some great fixed rates out there on the Advantage side. For owner-occupied, you've got a combo rate there at 2-year P&I up to 80 at 379. So you've got some really strong fixed rates out of there. So, for your clients who, are a bit cautious on the rate side of things, and probably particularly on your owner-occ, fixed rates is something to definitely consider.
Yeah. I think, the lenders will always cry, cost of funds and things like that. But obviously some lenders are eating more margin than others at the moment. And I think if the market stays stable and you can be in that market at a particular rate, if there is no change of government, so there's no change in things, or people are sitting back and saying things could happen differently, nothing really should happen to your cost of funds. Whether your inflation's going up or down, or your Australian dollar is going up or down, employment levels, they're the things that'll have an impact, and really there's no change to that at the moment. So I would think that if there is a change in government, there will always be that time where there's where is the even playing ground, and there's some uncertainty in the market, volumes drop off, transactions drop off, and then they'll pick up in another 2 or 3 weeks. So I think if there's a change of government, we might find that it slows a little bit during July, and maybe some of the clearance rates will come off a bit. But if the Liberals get back in, I think it'll be business as usual, and you shouldn't see that fall in the market. But regardless, I suppose if there is the chance of maybe rates changing, it could give your customers some urgency to get that refinance done, to maybe lock in that great fixed rate, get that deal settled by the 30th of June. So, again, the unknown, and we don't know what we don't know. But at the same time, your customers, it could be a good time to create some urgency to get that refinance done and settled.
Yeah, absolutely. And I think for a lot of your clients, we're now talking fixed rates with the 3 in front of it. So you're talking really great rates in a sense for the fixed option. For those clients who do want that little more safety and uncertainty, you are fixing it, at a great rate. I think the days of fixed rates dropping and you being 2 or 3% out of the market, just given where our rates are today, is not realistic, because even if the rates fall, how much further can they fall from now? It's a really good opportunity to look at fixed.
I actually had an old bank manager that said to me once, he said, if you can get a fixed rate that's 25 basis points below where your variable rate is, it's generally not a bad time to fix. And then if you look at the cash rate at the moment, how much lower can it go?
Exactly right.
So if you're getting a fixed around that, the mid 3s or even high 3s, it's probably a good thing for your customer. I mean, not that we can give advice, but it's pretty good chance that you're not going to look, give them, like used to happen, is put them in a fixed rate, and then the next week they come down, and then the customer's saying, "Oh, what the hell's happening?" So no, that's it. So I think we've pretty much covered everything there, and again, it's been great to catch up and have a chat with you, Jess.
Thank you, MJ.
I think it's good because it's not just about Connective Home Loans. We get an opportunity to have a real chat about what's happening in the market, and it's great that we also get some input from our brokers as well. So again, actually we've got one was, do you feel property prices will drop by 20% in 2 years when 90,000 plus off the plan units come into the market? Well, Joy, that is I suppose the one risk thing from the lenders and the risk people within in the banks is that the concern is that there will be a lot of those in the market. There's another side to that as well, is that you'll have, I think, Greville Paps from Wallstab, Brady Paps, did an article the other day, not so much talking about those in there, but really talking about the high density and oversupply of that type of particular, accommodation. So a slowing in that particular accommodation, but then again, the other markets really keeping pace because there is that requirement for it. It's no crystal ball on the table, so it's a hard one to answer. But obviously, it's a matter of, usually a good indication is to look at the way lenders behave with their policy. I don't think, it's completely dried up at the moment. We're finding that some of those off-the-plan purchases are coming in maybe 5-10% under. I think that's the experience. But then generally, by the time they get to settlement, you're getting back that 5 to 10. So early days, they're coming in under. But when it gets closer to settlement, when they do have comparable sales, we're finding that the vals are coming back up again. So, it's a hard one. Watch this space. So, that's it. All right, guys. Thanks again for your time. That's it for this month's Connective Home Loans TV. I'm Michael Gurner and Jess Fayano. Thanks again.
Thank you.